We are now in week 3 and we will be looking at chapter 2A, Budget Basics. This week as you go through the material, I really encourage you to take time to look at the chapter in the book. This presentation will be a very brief overview of what is there, but if you look through your book, you'll see that there are lots of formulas and numbers. And before you do the assignment for this week, I strongly encourage you to make sure that you understand the material. So obviously, anytime that we're talking about budgeting or the financial condition of a business, we are most interested in profit because that's what you get to keep. Profit is found by taking your sales revenue, subtracting the variable cost, then subtracting the fixed cost, and that'll give you what you have left to spend. So let's look at each component. Sales revenue is if you were selling plants in pots, the number of pots that were available for sale minus any that you couldn't sell times the price. In other words, how much cash did you bring in? Variable costs are direct or operating cost. This means costs that are incurred as a direct result of growing the crop. So examples might be the pot that the plant is grown in, or the media used for that specific plant. Fixed costs are overhead or indirect costs, which will be incurred regardless of whether or not the plant is produced. So the water bill, the electric bill, taxes, all of those things fall under the fixed cost category. So if you were to look at page 2 of chapter 2A in your book, Table 1 has examples of variable cost as well as fixed cost. Be sure that you can differentiate between those two. Sometimes people get a little confused, but keep in mind that fixed costs are going to be there regardless of whether or not you produce that specific crop. Variable costs only occur because you are producing that crop. So let's move on to page 3 and take a look at the variable cost for a poinsettia crop. You'll notice here that the book has broken down variable costs for poinsettias into poinsettias in a 4-inch pot, a 6-inch pot, and an 8-inch pot. So if you look carefully, you'll notice that for the cuttings, for a 4-inch pot, you've got 51 cents, which means you're probably putting one cutting in a 4-inch pot. A 6-inch pot has the same cost, so you probably are still putting one cutting. But when you get to the 8-inch pot, you'll notice that the price for cuttings is $1.53, which implies that that 8-inch pot is going to require 3 cuttings. And then you can see listed here the variable cost associated with each size pot. So when we look at the total variable cost, we see that the price of producing an 8-inch pot based on variable cost is significantly larger than a 4-inch pot. And when it comes time for you to determine the selling price, you're going to have to take into consideration how much you need to charge for an 8-inch pot compared to a 4-inch pot and adjust your prices accordingly. Once you have calculated your variable cost, obviously you're going to have to calculate your fixed cost. And to calculate fixed cost, we have to get a general understanding of depreciation. Depreciation is something that you will probably want to talk with your accountant about once you start a business. However, we have a simple definition of annual depreciation here, but there are again multiple ways to calculate depreciation, and it's dependent on what you are trying to depreciate, and you'll definitely want to talk with an accountant to make sure that you are using the best method of depreciation. What you see on the screen now is just a simple method of calculating annual depreciation. To calculate it accordingly, you would take the known purchase price, what you paid for something, subtract the salvage value, or what's the value at the end of that usable life. And if you're going to use a Marx system of annual depreciation, which is just a tax basis depreciation, that usable life is already established. Otherwise, it's an estimated value. And then you divide that by the useful life, or the years that the equipment or the machinery or the building or whatever the case may be will be in use. So again, take the purchase price, subtract out what it will be worth at the end of that useful life, and then divide it. So, an example. If you bought a piece of machinery for $10,000, you plan on using that for 5 years, and at the end of 5 years, the value of that would be $5,000. Then you would take the $10,000, subtract the salvage value of $5,000, and divide by 5 years, which would give you an annual depreciation of $1,000 per year. So if we return to your book on page 4, Table 3 has a listing of fixed costs for the greenhouse that was growing the poinsettias on page 3. Here you'll see again that fixed costs are things that are going to be incurred regardless of whether a particular crop is grown. So, for instance, advertising. Your advertising fixed cost is $1,400. It doesn't really matter how many plants you produce. You have invested $1,400 in advertising. Taxes, utilities, all of those things are listed there. You'll notice that this table does not include depreciation. So if you were calculating the depreciation for this particular business, you would probably want to include that in the other column. Table 4 from page 4 in your book so that we can look at this a little closer. When people calculate fixed cost, since it's not directly associated with each plant, it's kind of difficult to know how you should add the fixed cost in to, say, an 8-inch poinsettia. Because how do you know how much of that $14,000 for advertising belongs to the poinsettia in an 8-inch pot? To do this, people use what's called a cost per square foot per week. So the first step is to take your total fixed cost, which in this example is $280,424, and divide that by the production space in square feet. When you divide the total fixed cost by the production space, it will give you a cost per square foot per year. So, and I have corrected, if you do the math, your book has an error here. So the answer that I have provided you in red is the correct answer. If you calculate this for every square foot of the greenhouse, you will need $5.49, roughly 50 cents. So roughly $5.50 to operate each square foot of the greenhouse. But that's a yearly cost. And you won't have poinsettias in the greenhouse all year. So we add one more element, which is the number of weeks. So we divide the $5.49 by 52 to get a cost per square foot per week of about 10.5 cents.